Hello and good evening, everyone. I am Sudhir Kumar, Director at CareEdge Ratings, and your host for today's webinar. I am part of infrastructure vertical, and with my colleagues, we specialize in power sector. On behalf of CareEdge Ratings today, I welcome you all to today's webinar, which is titled Indian Ambitious Renewable Energy Target, Would BCD and ALMM Cast Shadows? I sincerely appreciate your time in joining us for this webinar. Over the past one decade, renewable sector has made very rapid strides in terms of capacity addition. Over the last 5 years, the sector has grown at a CAGR of around 13%, with majority of growth led by solar segment. However, the overall progress has been affected due to various issues, including COVID, supply chain disruptions, hardening of commodity price, etc. Further, the imposition of BCD and ALMM has impeded the capacity additions of late. In this context, we thought it would be pertinent to bring the industry leaders on this forum and try to get their views and opinions on few of the pressing matters of the sectors today. We would now like to welcome the esteemed guest speaker for today in alphabetical order. We have Dr. Hitesh Doshi, Chairman and Managing Director, Waaree Energy Limited. A very warm welcome to you, Mr. Doshi.
Thank you. Thank you very much.
We also have Mr. P.K. Sinha, Executive Director Projects, Power Finance Corporation Limited. A warm welcome to you also, Mr. Sinha.
Thank you, sir, and welcome to all.
Yeah, and we also have Mr. Shivanand Nimbargi, MD and CEO, Ayana Renewables and Power Private Limited. A very good afternoon to you, Mr. Shivanand Nimbargi.
Thanks, Sudhir, and thanks for having us today.
Yeah, and we also have Mr. Vineet Mittal, Chairman, Avaada Group, also on the panel today. Very warm welcome to you also, Mr. Vineet Mittal.
Thank you, Sudhir. Namaste.
Namaste. This session will be moderated by my colleague Rajashree Murkute, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Jatin Arya, my colleague and Associate Director at CareEdge Ratings. This will be followed by a panel discussion. We would have a Q&A session with the audience at the end of this discussion. In case of any queries or questions, you are requested to key in your panel. Now, may I now invite Jatin to make his presentation. Over to you, Jatin.
Yeah, thanks, Sudhir, for the introduction. Good afternoon, everyone. The content flow in today's webinar includes the following. First of all, we would be focusing on the reasons why India underachieved its 2022 targets. Then we would also look into the RE capacity addition prospects, the key trends with respect to bidding activity and M&A in the sector, followed by the key sectoral headwinds and tailwinds. And lastly, we'll also focus on the CareEdge Ratings outlook on the whole RE sector. Moving forward, as reflected in Exhibit 1, the total RE capacity of India stood at 121 gigawatt as on December 2022, as against 110 gigawatt as on FY22 end. The share of RE as a proportion of the overall power capacity has increased from 14% as on March 16 end to 29% as on December 22 end. The rising share of RE capacity in the overall power capacity has been primarily on account of the strong policy focus by the government, as well as the improving tariff competitiveness as against the other sources of power. Focusing on the reasons why we still underachieved the 2022 targets. In 2015, India had committed to increase its RE capacity to 175 gigawatt, which would comprise 100 gigawatt from solar, 60 gigawatt from wind, 10 gigawatt from biomass, and 5 gigawatt from small hydro. Against these targets, the actual achievement has been 121 gigawatt, thereby highlighting the shortfall of around 54 gigawatt. The primary reasons for this underachievement include the impact of COVID, which has actually resulted in project timeline extensions. Secondly, the supply chain disruptions, primarily in China. Thirdly, the other regulatory risks, primarily on account of delay in tariff adoption, delay in signing of PPAs and PSAs. As reflected from our Exhibit 4, India had targeted to install 40 gigawatt of rooftop solar, and there has been a significant underachievement in this segment. This is primarily on account of policy and regulatory bottlenecks caused by the apprehension of possible revenue loss to the discoms. Further, there have been lack of uniform regulations across states, as well as delay in installation of net and gross meters. Other factors include lack of awareness of the benefits of rooftop solar, weaker rooftop structures primarily in the rural areas, as well as low financing avenues for this segment in particular. Going forward, the government and the shareholders need to address the mentioned challenges if India has to realize its full potential in the rooftop segment. Moving forward to the RE capacity addition that has taken place so far and the prospects. As demonstrated in Exhibit 5, the solar power segment remained the key driver of capacity addition in the RE sector, with significant capacity addition over the past 6+ years. This has taken its share in the overall RE mix to 52% as against 17% as on March 2016 end. Despite RE capacity comprising roughly about 30% of the overall energy capacity in the country, its contribution in the overall generation remains subdued between 10 to 11%. This is primarily on account of intermittent resource availability. As demonstrated in Exhibit 6, India installed 11.3 gigawatt RE capacity in 9 months FY23, which is a 9% rise over the similar period last fiscal. Going forward, CareEdge expects the annual increment in the capacity to be in the range of 15 to 17 gigawatt, which would primarily be supported by a healthy pipeline of 45+ gigawatt. The key bottlenecks which have been impeding the growth include hardening of module prices apart from imposition of BCD and ALMM, lack of adequate domestically manufactured modules, as well as transmission and land availability related constraints. However, if India has to achieve its target of 450 gigawatt RE capacity, the annual installations have to be in excess of 40 gigawatt. Given the prevailing industry environment, achievability of this target, these targets remains unlikely. Focusing on the overall M&A activity and the bidding activity in the sector, the RE sector in India has witnessed an increased M&A over the last 24 months with 13+ gigawatt changing hands. Going forward, CareRatings expects further consolidation in the industry, and that has to be driven by the strong global investor appetite, large growth potential in the country, as well as benefits arising out of a diversified and large asset base. Most of the deals that have taken place have been completed with EV by EBITDA multiple between 7.5 to 10x, varying according to the balance life of the asset, the PPA tariff, as well as the counterparty. Focusing on the bidding trends, previously the feed-in tariff regime was applicable in the country, wherein the tariffs were determined somewhere in the range of 4 to 6 rupees across various states. Bidding in wind resulted in decline in tariffs to a certain extent. However, there has been a certain uptick in the discovered wind tariff in the limited winds that we have seen in the past 12 to 18 months. However, the investor interest in this segment has waned. As a result of it, the government has introduced a couple of key policies, one of them being the introduction of offshore wind policy that aims to set up 30 gigawatt of wind capacity by 2030. Apart from it, the government has also initiated the pooled bidding concept, which would lead to incremental addition of 8 gigawatt annually. Similarly, for the solar segment, there have been very few incremental bids conducted by the central counterparties in FY23. I'm primarily focusing on the plain vanilla bids here. However, in the limited bids that we have seen in the state along with the central counterparties, there has been a certain uptick in the tariff, taking it closer to rupees 3 per unit. And this factors in the hardening of module prices as well as the interest rates. While the proportion of plain vanilla bids has reduced, there has been an influx of innovative bids. Focusing on the same, the innovative bids also comprise of the hybrid bids that have come in. The contribution of hybrid bids is more than 5 gigawatt over the recent past, and that has been allocated by SECI alone. These projects actually enable optimal and efficient utilization of common infrastructure as well as reduce variability. The latest hybrid tender of Ramsal witnessed an increase in quoted tariff compared to the previous tenders, highlighting the increased input cost pressures and hardening interest rates. Further, there have been other innovative bids, primarily including peak off-peak power, round-the-clock supply, and supply using battery solutions. The tariff determined in these bids remain competitive as against the cost of generation of recently commissioned as well as upcoming thermal power projects. However, if India is yet to witness a utility scale project having storage as a key component. Moving on to the key sectoral headwinds and tailwinds. In our opinion, these 5 are the major factors affecting the industry. In subsequent slides, we'll be speaking in detail about each one of them. Focusing first of all on the underperformance of the wind assets. CareEdge Ratings analyzed the generation performance of its monitored operating portfolio comprising 8.5 gigawatt wind assets and 14.5 gigawatt solar assets, which is reflective of the country's overall operating renewable energy portfolio. The generation performance of wind assets has witnessed a significant decline over the 3-year period from FY20 to 22, in contrast to the steady performance of the solar assets. Some of the key takeaways from the analysis include the following. Wind power generation for only 11% and 17% of the portfolio was above designed estimates in FY21 and 22 respectively, whereas solar power capacity of around 50% was above the P90 levels during the same period. Further, in FY22, 6.9 gigawatt, that is 82% of the monitored wind energy assets reported underperformance vis-a-vis the designed estimates, while the corresponding figure was 7 gigawatt, that is 49% of the portfolio for the solar assets. Further, over the 3-year period, approximately 53% of the 8.5 gigawatt wind assets could not achieve the designed estimate, as against only 31% of the solar asset. That is not achieving the designed estimate in any one of the 3 years. Lastly, the extent of underperformance vis-a-vis the designed estimate has remained lower than 3% for the solar asset, as against 4 to 15% for the wind assets. Given the higher risks for these wind assets, even after commissioning, Care Ratings believes it is incumbent for a wind project to possess stronger debt coverage metrics and higher liquidity reserve than a solar project, so as to counterbalance the emanating concerns. The generation performance in the current year in the wind space has not been very different from FY22, thereby amplifying the concerns for this segment. Moving on to the impact of BCD. The average price of monopoke modules, which are considered to be the mainstream modules, has increased by more than 35% from 20 odd cents as on Q2 2020 end to 27 cents as on Q3 22 end. The project cost has further increased for the Indian developers due to depreciation of INR against the USD by 8% during the same time period, as well as increase in GST rates on modules from 5 to 12%. Further, due to applicability of ALMM, for all the domestic projects, excluding only the BTM projects, there has been a demand-supply mismatch, resulting in upward pressure on the module prices. The landed price of imported modules is around 43 to 44 cents. This includes 40% of BCD. However, if cells are imported and converted by paying tolling margins to an OEM, the landed cost to the developers is around 36 to 37 cents. If we focus on the trend of the last couple of months, there have been some green shoots with moderation in the module prices by 1 to 2 cents. This is primarily on account of increased supply from China. As per Care Ratings, a significant portion of the plain vanilla solar projects stand out of the money given the prevailing module prices, while the government has been supporting the developers through timeline extensions, as MNRE recently extended the commissioning timeline till March 24. The prospects of these projects would remain hanging, in our opinion, and this would become viable only if there is significant moderation in module prices, or if the government decides to exempt certain projects from paying BCD, given the lack of adequate domestic module supply. Moving forward, we have assessed the impact of higher module prices on the determined tariff, and as per our analysis, the bid tariff will have to undergo an increase by 30 to 50 paise to ensure the developers have similar returns as they were getting in the pre-BCD regime. Despite this increase, the bid tariffs for these solar projects are expected to remain below 3 rupees per unit. Going forward, the counterparty credit risk remain high in the key states given the continued weak performance of the discoms. The distribution segment has been the weakest link in the power sector value chain owing to the long-standing dues of the state-owned discoms related to weak operating efficiencies, inadequate tariffs, as well as inadequate subsidies as compared to its cost of supply. To address these long-standing problems of stretched receivables, the Ministry of Power has allowed discoms to clear their outstanding dues with late payment surcharge in equated monthly installments. On June 3, 2022, MOP issued the Electricity Rules 22, wherein the payment of outstanding dues, including principal and LPS accrued up to the date of the notification of the rules, will be rescheduled, and the due dates redetermined for payment of EMIs between 12 to 48 months. Apart from clearing these past dues, the discoms have to also ensure that the current dues are serviced timely. Thus far, what we gather from the developers is that they have been receiving payments in a timely manner from discoms pertaining to the EMIs as well as the current dues, and a total of 6 EMIs have been released. There has been a material reduction in the receivable cycle in key states of Andhra Pradesh and Telangana, wherein the discoms have opted for paying the dues in 12 EMIs. The discoms are receiving funding support from PFC and REC to clear these dues through these installments. Going forward, the payment pattern from these discoms would continue to be a very key monitorable from a credit standpoint. Moving forward onto the manufacturing segment, till FY22, more than 80% of the domestic module demand was being met through imports. To save on foreign exchange, the Indian government has increased its focus on developing a domestic ecosystem. The first step in this line was mandating only the domestically produced models in the ALMM list. Further, the present ALMM list includes only 19 gigawatt of module capacity, and a significant portion of this capacity is outdated, leading to supply side constraints for the industry. Therefore, to enhance domestic manufacturing, the cabinet approved a PLI scheme with an outlay of rupees 24,000 crores. Out of the same, PLI of around 4,500 crore has already been allocated through tranche 1, which would result in addition of fully integrated capacity of 8.7 gigawatt. A PLI tranche 2 has also been announced, and this would include addition of capacity of somewhere around 65 gigawatt with a budgetary outlay of 19,500 crores. Once all this capacity becomes operational, India would have its own up-to-the-date module manufacturing capacity in excess of 75 gigawatt, and this would remain as a key if India has to achieve its RE target of 450 gigawatt in 2030. Moving forward to some of the regulatory certainties as well as uncertainties. While clarity has emerged on some of the previously open issues which has supported investor sentiments, some of these clarities and the driving factors include MNRE granting extension in commissioning of under development solar, wind and hybrid projects till March 24, phasing out of reverse bidding in order to revive the wind segment. Further, Ministry of Power has also notified the trajectory of RPO from FY23 till FY30 and ESO from FY24 to FY30, providing a roadmap for RE capacity addition. The RPO is set to increase from 43% is set to increase to 43% by FY30 as against 23% in FY23. The ESO target is increasing from 1% in FY24 to 4% in FY30. Moreover, the commitments from the center at the global forums have only been enhanced, and the same can be measured by the country's ambitious targets of achieving 500 gigawatt non-fossil fuel capacity by 2030. Some of the other initiatives that reinforce the commitment include introduction of green energy, open access rules, and national hydrogen mission. While clarity has emerged on some of the previously open issues, a few of the past issues remain open. They primarily include pending PPA-PSA signing of more than 10 gigawatt capacity, the great GIB issue, the Great Indian Bustard issue, which has been hampering the progress in key states of Gujarat and Rajasthan. And lastly, while MNRE has granted imposition of BCD as a change in law event for projects wherein the date of bid submission was prior to March 21, a similar outcome is yet to be announced by the key states. Moving forward to CARE Ratings outlook on the RE sector. the rating distribution mix for the wind and solar power projects as on December 2022 is shown in the exhibit. The mix of investment grade ratings in the wind and solar power projects remain high at 91%. The high proportion of ratings being in the investment grade is on account of strong parentage, satisfactory track record of operations, diversified asset mix, strong liquidity profile of various SPVs, as well as strong coverage indicators. Whereas a few of the assets continue to be in the sub-investment grade category, that is BB and below. And this is primarily on account of absence of a strong parent, weak operating performance, and no firm offtake arrangements for those assets. Coming on to our outlook, the presence of supportive policies, strong central counterparties, adequate resource availability, as well as strong investor interest is likely to result in the capacity growth. However, there would be an increase to the extent of 30 to 50 paisa in the RE tariff, taking the determined tariff to between 3 to 3.5 rupees per unit. The key challenges pertain on account of imposition of BCD and ALMM, along with execution-related bottlenecks. Thank you, everyone. Over to you, Sudhir.
Thank you, Jatin, for making the insightful presentation. Now, may I invite Ms. Rajashree Murkute to take over the session, please. Rajashree is a senior director and heads the infrastructure vertical at CARE Ratings. She has 20 years of industry experience, specializing in corporate credit rating with a focus on infrastructure sector. At CARE Ratings, she has led various rating teams across diverse sectors within infrastructure and corporate verticals. Over to you, Rajashree.
Thank you, Sudhir, for the quick introduction, and Jatin for the wonderful deck presentation. Good evening and a very warm welcome to one and all who've joined us for today's webinar on Indian renewable energy sector. We have today with us undoubtedly some of the best minds from the industry to discuss on the subject and place the valuable perspectives before us. So I would like to introduce you to our esteemed panelists in the alphabetical order. Our first panelist is Dr. Hitesh Doshi. Dr. Doshi is Chairman and Managing Director of Waaree Group and has been a career entrepreneur for over 3 decades. He has established several ventures, including global scale manufacturing in sectors ranging from process control instruments, gas station equipment, industrial valves, before moving on to the entire value chain in solar industry. As CMD of Waaree Group, he's been instrumental in the growth of Waaree Energies, not only in the solar industry, but the growing new energy business. An active speaker at various global forums on energy transition, family businesses and entrepreneurship, Dr. Doshi is also closely associated with various philanthropic and social development ventures. Welcome, Dr. Doshi. Our next panelist is Mr. Kumar Sinha. Mr. Sinha is ED at Power Finance Corporation, heading Northern Region Solar Wind Project Processing Cell and Stress Asset Unit. Mr. Sinha has over 34 years of experience in the power sector, of which 29 years are with PFC. He has wide experience spread across the value chain of power sector, including planning, maintenance and financing of generation, transmission and distribution segments. Mr. Sinha is an electrical engineer and holds an MBA finance degree as well. Welcome,
Thank
Mr.
you.
Sinha.
Thanks for the introduction.
Our third panelist for today's session is Mr. Shivanand Nimbargi. Mr. Shivanand is MD and CEO of Ayana Renewable Power, one of India's prominent renewable energy companies. He is an industry veteran with more than 30 years of experience spanning energy, transport, and infra sectors. Prior to Ayana, Mr. Shivanand has served as MD at L&T Metro Hyderabad, and before that, as CEO of Green Infra Limited. It's a renewable energy platform backed by IDFC. Mr. Shivanand has been on the board of NTPC Alstom joint venture and is also part of FICCI's Renewable Energy Council. He's a graduate in mechanical engineering and has also pursued advanced management program at INSEAD. Welcome, Mr. Shivanand. And now let me introduce you to our fourth esteemed panelist, Mr. Vineet Mittal, Chairman Avaada Group, which is a prominent integrated energy group with business interests in solar module manufacturing, electrolyzer manufacturing, and green ammonia production. An alumnus of Harvard Business School, he currently also holds the position of Chairman of the MNRE's Subcommittee on Hydrogen Usage and Standards, Chairman of the CI National Council on Climate Change, and Chairman of the Make in India Task Force. He is on B20's Task Force for Financing Growth and Infrastructure, and Energy, Resource Efficiency and Sustainability. Welcome, Mr. Vineet. Now for a few preliminary remarks on today's theme. With the Indian renewable energy sector going through an extremely dynamic phase with vast opportunities to scale up, necessitating major investments to build and upgrade the existing infrastructure, in a bid to monetize these opportunities, even the government governing authorities as well as private participants have been closely working together over years. All India installed capacity is expected to reach about 623 gigawatt by FY 26-27 and about 866 gigawatt by 2031-32 from the current level of 409 gigawatt. Yet we see the challenges in the form of supply chain disruptions, regulatory uncertainties, volatile PLFs, technological advances. They all persist and continue to pose as roadblocks. Therefore, from infrastructure creation perspective, it becomes imperative to understand how are the challenges unfolding and tackled at each level. And because of so many questions and thoughts hovering on these issues, and as well as presented by my colleague Jatin, we felt it appropriate to hold this webinar and get our industry experts deliberate on these ponderables. So let me not impose myself further on these, and I'm sure we'll have the experts tell us how they think the situation will unfold. So my first question is to you, Mr. Vineet. So in a bid to realize in India's renewable energy ambitions, which has been spoken of, according to you as a developer, do you think there is a need for the Indian government to further exempt BCD or reduce rate of duty on the solar modules, especially in the context of the current low domestic capacity which is operating? And we also have existed extensions which are in place for project commissioning. So do you still think there is a need? Mr.
Rajashree. Yeah. So let's understand the context in which Government of India imposed BCD. The government wanted to encourage the domestic manufacturing of solar panels and entire value chain. And their intent was that we have an ambitious target to become net zero. And our ambition is to grow responsibly. So in their wisdom, they announced various measures which can create a level playing field with the other countries. There were countries who had offered extremely high capital subsidies, lower electricity tariff, and creating the ecosystem by providing subsidy, etc., and which made kind of difficult for any other country to produce successfully solar panels. So government decided that they want to become among top 3 players in the solar value chain. And in order to make it successful, they consulted the entire industry and they came up with guidelines on BCD and ALMM. So the challenge happened is that a lot of these discussion and consultation happened in 2019, and post-COVID, our ability to communicate in person reduced, and the changing scenario was not communicated to the government. So government, what they planned in October 2019 in their RE Invest, they implemented in 2021, and that's where the challenge came. The scheme is good, but the implementation is not timely. If it would have come next year, we would not be talking about these challenges because a lot of the capacity would have come. And PLI, which was supposed to come in 2020, got announced late in 2021, and then second phase is yet to be out. So I think there were some constraint in execution due to COVID, due to external scenario. But the intent to put BCD and LMM is good, and I think it would be a bad idea to roll back BCD because what industry and global investors are looking at is the policy consistency. You can't keep changing the policy every year. You have to have a 10-year view on the policy, and there has to be a sunset clause so that investors can price the risk appropriately. Maybe for private sector and CNI sector, government can look at different criteria. But in government's project, I would suggest that government should continue with the policy consistency, and there will be a challenge this year also. But hopefully by middle of next year, we would see the value chain getting developed locally, and that would have a positive impact on the sector overall.
Okay, thanks. So prima facie, what you were essentially saying is it will not be a great idea to roll back, the BCDs, and actually there has to be a consistency so that the investor appetite and the developers also can create a good foothold in future.
Or for the people who are investing in manufacturing,
Absolutely.
why should they invest if government can change the policy in 6
Correct.
months of pressure? Then how do you price that risk?
In fact, coming to you, Mr. Shivanand, on the same on the same question. So, because of this prevailing duty structure, what are your views on the trajectory of solar tariffs, especially in the near to medium term?
So, currently the sector has, rightly said during the presentation, has come to kind of a standstill. Okay. So while the intentions are good, as Vineet mentioned, the timing. Okay. So the capacity addition is getting impacted because end of the day, there has to be a certain level of returns in terms of the equity investors, in terms of the debt servicing, and being able to meet the various covenants under the lender agreements. So that is paramount for any investment to be successful. And policy and regulatory aspects, no doubt, cannot be introduced and rolled back, as rightly said. But at the same time, we'll have to find a balance between all three aspects. One is the energy security aspect with which, and also self-reliance, and to promote Make in India program. That's one aspect of it. Second aspect of it is our own targets of being able to meet the net zero or the immediate 500 gigawatt targets of 2030. And third is we as a nation have got to have power at a competitive rate, because power is an input. Other than everything else, it does make a huge difference. For example, if we look at the solar module itself, if we have to go back to producing polysilicon, 70% of the cost is going to be the cost of the power. So unless and until the cost of power is not competitive, polysilicon cannot be produced at a competitive price, which is the process where the whole backward integration has to start. Just by assembling modules or bringing in cells and doing the value addition very limited in the country. So to get to that, obviously, is going to take some time. So I think probably a balanced view might be needed as to the trajectory in which the domestic back-end integration, everything that happens along with the latest, PLI scheme, which is there. All these initiatives are likely to take about 2 years of time. That's why from an industry perspective, we said that let's try and balance it out so that there is time for the domestic capacities to come to the required, requirement for local capacity additions. At the same time, they could also, find ways to be competitive with respect to backward integration. And the tariffs that have been seen earlier and now what we are seeing, somewhere there could be a rationalization to make sure that growth continues and tariffs continue to remain at a level where investors continue to be attracted to invest. And it's not just about winning bids, as we have seen. We have more than 10 gigawatt of bids which are not going anywhere. Post bid, post LOA, post PPA, post PSA, everything else. Because end of the day, economics have got to be in favor to implement the project. So I think we are hopeful that some kind of a middle ground will have to be found to meet all the aspirations of domestic manufacturing plus capacity addition. So tariffs in the short term, to answer your question, are going to remain firm because we are not really seeing so much of softening, though there is some softening of pricing on polysilicon. So how much that actually gets translated, we need to see. So at the moment, I think it is quite tough to say, whether at the moment, I mean, in your presentation also we heard telling that a correction of 30 to 50 paise is needed. So probably that is where we should see the bids going forward.
Got it, sir. So again, yeah, indeed, it has to be a very tightrope act which the government has to place so as to ensure that all the stakeholders actually go hand in hand without jeopardizing anybody's interests. Now we've heard the interesting insights from the developers. I would now urge Dr. Doshi to come in here as a module manufacturer. So there have been increasing talks with IPPs actually also vouching for either a reduction in BCD or wait and watch. So if that materializes, do you think the presence of ALMM will help domestic module manufacturers hold ground against the Chinese counterparts? What are your thoughts?
Well, thank you. Thanks for inviting. And see, I think manufacturing flight has just taken off. The policy, the manufacturers, and like Vineet has said, the investors were not confident to invest in manufacturing. So after the April, which is now less than 10 months, the policy came in place. The country's whole module manufacturing was at 10 gigawatt. In 9 months, it has reached to now 30 gigawatt. It is not listed yet on a ALMM because of some technical issues. But when you put the manufacturers and their capacities, and by next quarter, it will be a 40 gigawatt. Similarly, on the same side, we were 3.5 gigawatt. And I think before the end of this calendar, it will cross the 20 gigawatt. Your estimation says that we will need a 15 gigawatt of modules this year. And capacity is already more than double of it. Right? Coming back to the duties and ALMM. The ALMM is definitely the most important tool, but implementation at the lower level, apart from the large projects, is very difficult. If somebody puts the module on his roof, nobody knows it is ALMM or non-ALMM. And there is no regulation today and no mechanism also to make sure that it is purely ALMM module. Rolling back the BCD or rolling back the ALMM will immediately open the doors of the FTA countries. And with the recent investigation on them, their export to the United States has completely stopped. So they will start dumping the material through here. So it's a tough call, like chicken and egg, where you want 1 or 2 years to suffer and make the India as a country with the energy security and the make in India, or you want to continue with this. And the biggest problem in this industry is, I have been here for now 17 years. The toughest job is the developers. They have to estimate through the crystal ball what will the price after 18 months for the module, interest rate, dollars, cement, steel, many things. And they have to bid. And unfortunately, the entire pressure of dollar or interest rate or everything comes on the module price. And then even if the duties have been there, this question comes in whether you want to roll it back or not. What will happen? The plane which is taking off, if we stop it at this moment with any, it will crash. And we lost 15 years. This is supposed to come 15 years back, and probably we'll lose the entire value chain and the supply chain in India for this. So I don't think it should be disturbed anymore at any moment. It should be pushed further, and India should be the second alternate to the globe, not only for India. Because personally, I'm saying we will cross 90 gigawatt in next 1.5 years. And that will provide the second alternative to the whole world's customers apart from China. Thank you.
So what I clearly gather from you, sir, is that there can be a short-term pain at this point of time, but in view of the long-term gains, perhaps we'll have to kind of continue and ensure that India becomes more sustainable when it comes to the component module manufacturers.
Right.
So moving on to the same segment now, the more important and the critical part comes the funding. I understand Mr. Sinha has stepped out for a meeting, so I would request Mr. Shivanand to take this question. Basically, what we've seen is the renewable energy has also faced quite a few challenges in terms of access to low-cost debt, especially in India. Yet, RBI recently had reported that lending to the renewable energy sector, especially by the scheduled banks, that has increased by close to 113%. I'm talking of the period between April to November 22 period. So, what are your thoughts on the funding challenge? Because on the other side, what we also see is the yields have hardened, and there is a projected global slowdown. So, do you think that the investor appetite is still strong for Indian assets? Because that's going to be very critical when we look at the equity requirements of the developers.
Yeah, I think on a financing side, looking from an equity side, what is critical for them is, what the country is there to offer in terms of certainty of being able to, make the returns that one anticipates while entering the market or while bidding. So that's an important element into that. And given that, apart from that also we have, apart from ALMM, BCD also, we have seen DSM regulations coming into effect last month onwards, which has a negative impact in terms of the revenues to the sector. So all these aspects do, impact in terms of how the overall equity, returns are going to pan out. Having said that, from an equity investment point of view, India continues to be still very attractive, despite all the challenges and everything, because there is a certainty of growth the country offers. There is a committed government which has laid out very clear path towards immediate 2030 targets, towards the net zero target. So there are clear plans. So there is a certainty of business despite all these issues. And the good thing that the investors look at is, though the challenges are there, the government has regular interactions, especially MNRE has on a monthly basis meetings with the wind developers and the solar developers to understand the issues and to try to find ways, especially how the ministry handled the time extension issues during the COVID time was really commendable. That really helped the industry to tide through. So similar interactions are happening between the industry and the ministry. Hopefully we'll find a middle path, as I mentioned earlier on. So that's as far as the equity investment is concerned. India will continue to be an attractive destination for the foreseeable future, for sure. Then number two is coming on to the debt side of the business. Hopefully, we are seeing the end of the tunnel in terms of rate hikes. I don't know, probably another 25 bips might be expected. I don't know, that's again a speculation. Also, one of the avenues for funding financing was the dollar financing. But given where those rates are going and given where the Forex is going, so that also has put added pressures. So given those things, that puts an additional burden apart from the supply chain constraints and other policy regulations that we have talked. That's why we are seeing certain slowdown, but hopefully that should come back. But in terms of some of the measures that could be taken in terms of the lending side, especially on the Forex, I don't know whether we have recommended to Government of India and in some of the forums is whether it is possible to look at centralized hedging kind of a policy and being able to tap into those resources. That's number one. And number two is the pension funds that is coming into India is quite negligible at the moment. There are a lot more other countries who have a huge pool of pension funds, whether we could try and look at some regulations which will help us to tap those kind of pension funds. And thirdly, multilat and bilat is there. How can we actually find way to, increase that pool and give comfort around that? one aspect where India is really moving up and in terms of these dollar financing is on the ESG side. I think most of the developers today have a lot of attention towards the ESG aspects, because that being there, that ticks a lot of boxes in terms of attracting the lending from the foreign side. So with all these things, I'm sure, we should be able to remain attractive from a lending perspective. And of course, domestic lending is available. We need to find ways to make it a little more competitive. That's my inputs.
Great. So broadly, equity is not really too much of a worry, because as I understand, India continues to be a good destination. Debt, anyway, some measures from the government, I think, and the interim wise, we will still be able to hold good, because the long-term prospects and the entire the direction that it is there for this sector is pretty much on a favorable side. So things should work out. Is largely what you're saying.
Yeah.
One of the other measures, when we look from the government side, the introduction of the PLI and the manufacturing schemes. So my next question is to you, Mr. Vineet. So government, as we also saw in the presentation, and we are aware, it had announced this PLI scheme of close to about 24,000 crores, basically to aid in setting up 60 to 70 gigawatt of module manufacturing capacity. In your opinion, what can be the other measures or steps which the government can take so as to ensure that there are minimum bottlenecks to achieve the targeted domestic module manufacturing capacity?
So I think all of this is started by the fundamental foundation was Atmanirbhar Bharat, which is what India adopted as its growth strategy in 2021. And they have been announcing PLI across the sector. But the key is actually to create the ecosystem. So today the challenge is that even when we are setting up manufacturing, the land, the access to electricity, water, effluent treatment plant, road connectivity, all of this is still a challenge. Though we have been talking about ease of doing business, but ready parks like what you get in Vietnam and China doesn't exist. Maybe one or two aberrations are there. So we need more industry clusters. We need clusters on the port as well, so that people who are focusing on export, they can have plug and play facilities to set up. Permission and approval are still decentralized, so you have to go for permitting to every agency separately. Though every state has a single window clearance, but eventually you end up going to individual ministry for different permittings and approval. So that's a big challenge. Third is due to our tariff structure by distribution companies, the tariff for electricities are very high to the end industry and consumer. And because of that, our electricity is still expensive. So government probably would have to continue supporting this industry for a longer term if they don't figure out a solution to pass on the advantages of low tariff offered by renewable to the industry. And the most important aspect is creation of the ecosystem for ancillary industry. So module manufacture actually has become very successful in China because they invested very heavily on the associated industry like glass, silver paste, industrial gases, junction box, whatever you need, it's available within 100 miles. Whereas in India, you have to go all over the places and the trained skill set still doesn't exist. So there is a lot more which industry needs to do along with the government to ensure that the skilled workforce is made available. But I'm sure these things will facilitate a lot more investment. But already government has shown a strong intent to help industries to succeed, and we are seeing a huge support from DIPP in every state to help industry to become successful in whatever area they choose to decide.
So I see a long list that you've recommended. Largely, in your asks are more from the industrial clusters that should clearly come up, facilitating ports, logistic parks, trained manpower, and a centralized clearance system, so that everything gets fast tracked and the process becomes far more smoother. Dr. Doshi, I would want to understand from you. So basically, in any case, module manufacturing has become a key theme for GOI. So given your experience in the manufacturing sector, what do you think are the key challenges that the industry could face, especially with aspiring to become a manufacturing champion for solar modules? This particular sector also is prone for rapidly changing technology, right? So how are the OEMs hedging their technology?
I'm sorry, I'm losing your voice a little bit. Can you repeat the last line?
Sure. So I just wanted to understand from you in terms of what are your thoughts as to the OEMs which are setting up the manufacturing capacities. What are the challenges that they are facing, which are coming in the way of becoming a manufacturing champion for solar modules? And second is considering there is a technological advancement which is rapidly happening in this space. As an OEM, how are they hedging their bets on the technology?
Right. Actually, the first thing is about what we need to be continue globally. The government support, and I think Vineet has covered most of them, and government is actively working on this, and a lot of things have already been implemented. Technological side, the advantage in this industry is that you get at least 6 months to 1 year well in advance. For example, TopCon is coming, which we are starting now. The industry was aware for at least 1.5 years before. So the entire value chain, OEMs, everyone was ready and they were preparing themselves to this conversion. That may be the size of the glass or maybe the other components like junction box and others. The same thing is now happening. The industry is getting ready for the next generation module, which may be the major product in coming days. That may be the GT or tandem. So fortunately, it is not like in the industry that we come to know today and it makes changes in 3 months or 6 months. A good 1 year is available for the entire supply chain. So there is no issue of converting these modules on time to time as per the latest industry demand and the technology available in the market.
Okay, so broadly what I understand is you're indicating that the OEM manufacturer is pretty much agile to adapt themselves to the changes, whatever the industry can put forth, and you have sufficient time in terms of 6 months to 1 year to take a plunge and transit into the new technology. So that gives them enough time to...
Yeah, now I can tell you one line also. In last 16 years, we have seen this changes every 2 to 3 years. So if there is no change, people will be worried. So it's another side.
Got it. So change is constant. I think we will also have the question and answer sessions from the audience very soon. So I would request the participants to key in their questions in the panel. While the questions keep coming in, I have a few to the panelists. Now, this is on the wind segment. A lot has already been spoken on the solar. My question is to you, Mr. Shivanand. We've seen that very clearly the installations in the wind segment have taken a backstage, and especially compared to the annual solar installations over the last few years. Indian government has already come out with an offshore wind policy, and there are firm plans to invite bids through pooling route for the onshore capacity as well. In your opinion, what can be the additional measures that the government can take to revive the interest in the wind sector?
So I think the current measures that have been taken, especially taking away the reverse auction and going through a closed bid process in terms of allocation, and also allocating the capacities by different states because of the RPO obligations. As you see now, the RPO obligations is specific for wind. solar has been combined with rest of the RPO obligations. So that itself gives the indication that government seriously intend to push out the bids and bring more wind. The challenge there has been actually, compared to solar, if we were to look why this is not grown. One was, I think, given the challenges the equipment supplier faced, they used to work in a turnkey mode, offering complete solution right from land and everything else, and do the project. And they were not used to the competitive bidding process. The sites were offered according to the feed-in tariffs, depending on what it was, and also for the C&I segment, depending on which state the power would be supplied. So essentially, the sector was not driven from a competitiveness perspective, but more on a stable regulatory environment where tariffs are assured and certain volumes are assured. So that's one part of it. Second is, I think with the competition, then technology holders and the equipment manufacturers started looking at newer technologies, which is looking with higher hub heights and longer rotor dias and improving the control technology of the turbine, thereby, trying to offer better yields. So as we stand today, we are looking at machines which are 3 megawatt plus and being able to work in sites 7 meters per second wind speeds. But I guess they will have to now move up to a higher size going forward, because there are not many sites now which are having higher wind speeds. The target that has been set, and if we want the wind sector to really grow, apart from the government support that is there, I think the technology holders will have to come out with higher size machines and higher hub heights and better technology, because most of the sites that are going to be available now going forward are going to be below 7 meters per second. And the cost cycle, unfortunately, has not been kind to them, because the costs have really gone up, and that's one of the reasons they have firmed up. And also now we expect them to get a little more competitive from the manufacturer side. Is earlier they had historical issues of execution, due to which profitability was impacted. But now, with the way the turbine contracts are structured, whereby only nacelles and blades generally come, the rest of the thing is outsourced with a technical responsibility under the OEM. So that reduces their risk. So they should try and relook at the pricing to make it more competitive. Whereas the risks on the developer sides are increasing. And that is one more actual thing which government can do to really de-risk these wind projects and make them, implementable in a defined timeline, is around the land. For example, in Karnataka, to get an NA, to get all the approvals to execute is a huge challenge. We have a timeline of 18 months to execute, but the approvals do take time. Whereas, for example, Rajasthan has good policy. You don't need an NA if it is an RE project. So that eliminates a set of approvals. So I think we are recommending to or requesting to MNRE or Central Government of India to bring out some kind of a uniform guidelines for wind projects in terms of the land, maybe for solar also included, because the biggest challenge on the wind projects is around the land, the right of way issues and other such things, because each turbine you need to navigate through the villages, roads and everything else. So it's a far more complex and a difficult execution. So other set of requests essentially would be two. One around the technology side, where the ownership lies with the OEM, and second is their pricing strategy. And on the other side, with respect to the state and the central governments, is to make execution easy from a land perspective. So I think if that is done with this support of taking out the bidding, I'm sure we should be able to see a lot more capacity addition in the wind sector going forward.
Understood, sir. So very clearly, there are asks both from the developer side and as well as to the government, developers to focus on the technology, improving their efficiency, which was long ignored for quite some time. And government anyways to come in as a bridge and ensure that the regulatory framework is far more convenient and supportive. I have one more question. In the meanwhile, I would want to check with Sudhir. Are the questions already there from the audience?
Yeah, we do have. Yeah, we do have.
Okay. So in that case, I would ask Sudhir to take up the audience questions and we'll come back after the questions. Thank you.
Yeah. Now we begin our Q&A session. We have a couple of questions from the participants to this webinar. So I think I would direct the first question to Mr. Doshi. I think there are a couple of questions on module manufacturing. So I would combine them into one. The question is that how are domestic manufacturers going to catch up on technology aspect with Chinese counterparts? That is question number one, Mr. Doshi.
Yeah, we are at par with the global panel suppliers. For example, 650 watt module is already approved by in ALMM, and most of the manufacturers, when it has gone from a 10 gigawatt to 30 gigawatt now, all these lines are the new. So the new technologies, everyone is able to make a 540 bifacial glass to glass, which is today almost 90% plus market globally. So technologically, there is no issue, it's at par.
Okay. And there is one more question on the module only by Mr. Mohit Vyas. He says that what we see in the industry is that Indian manufacturers are exporting better quality modules, and that is creating shortage of supply in domestic markets. Any comments around this, Mr. Doshi?
No, in fact, see, we have this data clearly that how much export is done and how much locally is been put for last 10 months in this year. And that data clearly shows that the capacity utilization of putting together in this country is not even at 30% today. So the export data and the local deployment data and the local manufacturing data, we just have to see the three numbers. There has been quite rumors and quite discussion about this export and other things, but factually the data speaks different.
Okay. There's one question from Jyoti Gulia. She is asking about what is the growth prospects for the CNI segment going forward in India. And this question is directed to both Mr. Nimbargi and Mr. Vineet. So maybe Mr. Nimbargi, you can start first.
So I think the C&I segment has been growing quite rapidly, and we see a lot of demand from the C&I segment. Also, there is going to be a new demand from industry and commercial consumers in terms of the round-the-clock requirements. So we expect that market to grow because most of the industry houses are now looking at moving towards a net zero in a certain time frame. As a first step towards that, apart from taking standalone solar or wind, most of them we expect to move towards round the clock. So the demand is there. The demand is going to grow consistently. So that's a sector which is quite attractive, I would say.
Okay. Mr. Vineet, the same issue.
I agree with you. We are seeing a large demand coming up, but there are only very few states where you are able to service the demands in. So it's not that you can service the demand in Telangana or many other states. And the challenge is that there are many smaller players who have entered the sector who after taking the contract are not able to deliver as well because the regulatory slide complexity is also very high. So when a CNI customer outsources and it doesn't get delivered on time, their confidence also reduces. So the challenge we are seeing is that there are states because of fear of losing out their good customers, they are still not giving you long-term open access or all the permits, and they are creating unnecessary internal trade barriers for you to succeed. And people are willing to sign PPAs, but the challenge is that in the last 4 years, we have just managed to do around 1.2 gigawatt, whereas the opportunity probably is 12,000 megawatt a year, but to service it, it's a challenge.
Okay. I don't know if Mr. P.K. Sinha is still around. There's one question for him. Mr. P.K. Sinha? Okay, this question is from Mr. Amit Kumar. He says how the financiers are mitigating the technology-related risk while financing the module manufacturing projects. If Mr. Sinha is not there, I think I would request Mr. Vineet to take up this question, if you may.
So actually, if you look at the technology roadmap is very clear, and Indian PLI framework, which has got approved by cabinet, has requirement on module efficiency. Though I believe some of those are highly theoretical right now in terms of the highest efficiency they are expecting, but government is incentivizing for manufacturers to go for the latest proven technology. And banks are very prudent because they have burnt finger in early 2010 and 11. So they are extremely cautious. They look at who has a well-capitalized company, who has good network in the US, who are the consultant working with you. Do you have a co-branding arrangement for the US market? So a lot of due diligence banks are doing before funding any manufacturing unit. So it's not that easy. And for that matter, the level of due diligence even on the solar and wind project have increased considerably after some bad stories. I think what is important now for India is if India wants both manufacturing and development work to succeed, they should discontinue reverse auction. The reverse auction is highly competitive and many times leads to wrong decision. And that is why you see that today there are 50 gigawatt projects are stuck. And many times you can blame on government and external factors, but a lot of it is to do with the viable tariff or unviable tariff. People who had viable tariff, their projects have come up despite those challenges. So the truth is that reverse auction probably have lost its merit now. And that is very highly visible both in the wind and solar sector, wind sector being such an old sector with total dependence locally. Why we are not able to do more than 1.5 gigawatt? The tariffs have to make sense, where everyone in the value system makes some money.
Okay. Okay. I think we have already overshot the time, but I will still take last two more questions. And one is for Mr. Doshi. And I think a couple of people are interested in knowing that, and this is from Sandeep Kapadia, and he says that there is a quite rapid movement in raw material prices from China. How do we manage such volatile raw material prices? And how do we protect ourselves in the contracts? Dr. Doshi.
I think this is the toughest thing to handle today. Like I said, the toughest job the developer have to predict the prices, and these are the commodity prices. To give an idea, in last 10 days, the prices have moved almost 20%, 40% down and 20% up. And particularly the contract which monopolistic has happened between this limited 10 companies globally. Even the contracts are made, they are not following it today. So it's difficult to answer. The thing is that take the as soon as possible the decisions and get the raw material in as soon as possible, instead of waiting and thinking that this will keep on changing. That will be that I will say. Like when you buy the gold, you buy the gold. Do not wait what will the tomorrow.
Okay. I think the last question from the audience is, I think this is directed to Mr. Shivanand. they're saying while there have been some traction in incremental PPA PSA signing, still around 8 gigawatt capacity remains where PPA have not been signed. Given the increase in bid tariff, in your opinion, what are the key factors which are still holding the discoms back in terms of signing the PSAs?
So, what they're really looking at is also, in the sense that about going ahead in signing them, because they're stuck at various levels also. And some of the projects, where the tariffs are lower to the current one, I think the question, if I understood right, is where the tariffs are lower, why the PSA and PPA is not getting executed. Is that right?
Yeah.
Yeah. Okay. So the thing there is also, I think everyone is looking at typically what has happened, is that we have gone ahead with the bidding without a PPA or not a PPA, but a PSA. The bidding entity should have secured a PSA with the potential off-takers before going for the bid and a committed range under which they would be willing to sign the PSA and a corresponding PPA, then the bidding entity could do that. Because of lack of that process being in place, we have had a bidding trajectory which has gone way gigawatts and all that, and that lag. And also in terms of the existing projects also, even the lower tariffs, we're not really seeing any great interest from the discoms to be able to take these volumes and be able to go ahead. So some of the discoms have met their solar RPO obligations, so they're not seeing much of incentive in terms of proceeding further. And now with the new tariffs and the regulations, not tariffs, the new duties and other things, even developers, are not really looking, because those tariffs might be tough for the projects to get executed. So there is, no push from the discom. There's no incentive for the developers to go ahead, given all the issues that are, prevailing around. So that's why we are not seeing any movement on those projects too. And that's why kind of construction has come to an halt, other than the C&I segment where the construction is happening. On all the backlog projects, there's hardly any construction happening in the country today.
Okay. Thanks for that input, Mr. Shivanand. I think that was the last question. I would now hand it over to Rajashree for the closing remarks. Over to you, Rajashree.
Thank you, Sudhir. Thank you again to all our esteemed guest speakers for their insightful views and patiently answering all the audience questions that were posed. Due to paucity of time, we could not take up all the questions from our side either. But Doshi, Mr. Sinha, Mr. Nimbargi, and Mr. Mittal, it was a great privilege to host you. And thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback or suggestions, please write to us at cop.com@careedge.in. Goodbye for now. I would request the tech team to log off. Thank you so much.
Thank you so much.
Thank you.
Thank you.